Good morning, everyone. Welcome to AllGen's quarterly webinar. This is our quarterly update and market review. Today is October 19th, 2023, and it's been a year. And I guess we say that every year, but every year has its own particular evidence, factors, circumstances. So I know there's a lot of uncertainty going on right now with what's going on in the markets, what's going on in the world, war, etc. So we want to kick this off and get some thoughts from you, Jason, on what's been happening, what we expect to happen. So welcome everyone again. And just quickly, we want to give you a quick overview of what's going to happen today. So we're going to start off quickly, as we always do, with the icebreaker to get you involved as well, with some polling questions, and then we'll have Jason do his typical market outlook. Then we'll have AllGen updates and then some Q&As. So we're going to start off with this question that you probably should see in your screen right now. Okay, and so what is your favorite fall activity? Okay, it's one, watching football as much as you can, going hiking, drinking pumpkin spice lattes. So this is the icebreaker, the light-hearted question, if you will. We'll get a more serious one as far as financial stuff is concerned in a second, but let's go ahead and answer that question, please, and we'll give you a few minutes to answer. And that survey says that we have a tie between watching football as much as I can or going hiking, camping, and having campfires. Spicy lattes doesn't do much for most people. Okay, so next question, poll question that we have is a little bit more financially driven. How are you feeling about the markets? I mentioned there's a lot of uncertainty, but want to know what, take a feel and get the pulse of our listeners. So are you very concerned? Are you somewhat concerned? I think it's a great time to invest. Or I know my financial plan is solid, so I'm not really worried. So go ahead and take a second and don't think about it too much. Just how are you feeling about the markets right now, and click there, and then we'll see how our audience is feeling right now. So there's a lot of very concerned and somewhat concerned. So no one is saying it's a great time to invest, and no one feels their plan is solid. I don't know if that's good about the market or is that a reflection of not having a financial plan. So we can talk about that later, but okay, we'll move on. That being said, Jason, why don't you kick it off?
Yeah, let's get started. So, just for recording purposes, today is October 19th, 2023. Welcome, everyone. Excited to share about the markets today. Obviously, a lot of craziness in the news, as Paul mentioned, with the different wars going on and inflation and all types of things. So, I'm excited to jump in here. So, if we look at this first slide here, just kind of gives you a pulse of what's going on this year in the top kind of main four pieces of the market. So you have like the S&P 500, which would be large U.S. companies. That's doing the best this year, up 14%. And then you have international, which would be second. That's up 5%. Small caps, represented by the S&P 600, is basically flat on the year. And then bonds are actually down 3%. So what's really interesting about this year is at any given point throughout the year, you've had different leadership. At the beginning of the year, you started off with small cap leading. And then when you went through the banking crisis, at a short period of time, you actually had bonds leading. And then you had international leading for components, or for portions of time in April and May. And then since then, you've kind of had the S&P leading. But as you can see here, right around kind of August timeframe, all of these started going down. And you had a pullback over the last few months, which is, I think, a direct correlation to how everyone's feeling right now, not being concerned. And that also coincides with, some geopolitical concerns with what's going on in Israel as well. So that could definitely cause people to be concerned. And I'll get a little bit into more of the sentiment side of things in a second. But let's take a, kind of a step back and look at over the last few years. So this is looking after the pandemic started. So kind of mid 2020, all the way here on the left side. You had a really strong rally kind of when you had a lot of quantitative easing, you had a lot of stimulus. The economy is really strong during this time in late 2020, early 2021. And then you had a major shift in 2022 when inflation started taking hold and you had a big pullback. And then in the S&P 500, large U.S. companies, since October of last year, which this is kind of a 1 year time frame from October of last year, and we had a very similar question last year how people were feeling, and people were very concerned at that time that about the markets, and understandably so. The market had just pulled back 24% from its peak up here to its trough, but then it did rally, and it's had a pretty strong rally actually since October of last year, and is up about 20% from the bottom of the stock market. But as you see this trend line I've drawn here, this red trend line, that is representing an upward trend. Both by that trend line right there, the S&P is above the 200-day moving average, which is also ascending. And you have higher highs and higher lows consistently, which is also textbook upward trend. That being said, we are testing this upward trend line right now. And so that's something we're watching. It's just tested the 200-day moving average a couple of weeks ago, successfully bounced off of that, but we're right around this area. So this is something we're going to watch for. If you break down below this, significantly, it could mean that we're going to continue in a downward trend. However, if you bounce off of this trend line like you did right here, this could be the start of the next leg higher. So something that we're watching. I pointed this chart out last time kind of as a warning. In July, I said, that seasonally, and this is a chart of seasonality, so it basically looks at the average returns of every month going back over a year. And the weakest time period is August and September. So the weakest months are those 2 months. And as you can see, it's the only 2 months that it's consistently been negative over long periods of time. Those 2 months are typically a weak time of the year. So seasonally, this is a very weak time of the year. I like this next chart, though, which really touches on kind of, last one it looked at each month. This is a very similar chart of seasonality and just takes the average returns, over a long period of time. And you can see towards the beginning of the year, this is a day count as we go through a full year. And you wonder why it's not 365 days, it's business days, market days. So, you can see you kind of start the year on average a little bit rocky, but then you have a nice rally kind of in the springtime. You kind of peak out in summer. And then on average over time, just like that last chart showed, somewhere around August and September, and actually through, if we take this period right here, through about the middle point of October, that is the weakest time of the year. That's the exact time frame that we just completed. So if you see this green line right here, it shows the seasonality or where we're at on this chart. We're just about to enter. In fact, we've already entered in the last couple of days, seasonally the strongest time of the year. So if this is, middle of October through the rest of the year, sometimes it's called the Christmas rally. Markets tend to go up this time of the year. So, I would throw that out there to say, not every year is the same, but on average over time, we just completed the weakest time of the year, and we're just now starting to go into the strongest time of the year. I would never base all of our investing strictly off the seasonality chart. But that being said, that is one thing you want to consider and one thing that we're looking at. So back to kind of where I was starting, one of our polling questions is a sentiment. So this is what's called the panic Euphoria model. Interesting name, but basically measures when people are panicking and when people are euphoric. People are euphoric usually when markets are doing really well. People panic when markets are doing very bad. The way contrarian indicators, and this is a contrarian indicator, a sentiment indicator, the way they work is the markets over time tend to do the opposite of what people are feeling at extremes. So when people are very scared, as this indicator would indicate right now, so basically when you go below this green line, it's showing that people are panicking. And I like this panic euphoria model because it's basically a conglomeration of a bunch of different sentiment indicators. So it's a picture of a bunch of them, and then what people would be concerned about if gas prices are high or commodity prices have gone up, inflation. So it takes a bunch of different sentiment indicators and puts them into one. So I'm not trying just to point out one indicator, but a whole bunch of them here. But you can see all these red dots, and we just hit recently below this level, which would consider extreme. every time you hit these red dots, not every time, but the majority of the time you hit these red dots, you have a pretty good rally. You can see this is 2000, the bottom of 2008, when you had the kind of feeling of panic. Then you had the same thing in 2016. Obviously, in the pandemic, you had that. You had it in 2019 right here. But every time you can see that happened, markets rallied afterwards. So, and then actually you did have it last year, and I pointed a similar chart out in October of last year when it started happening, and you did have a rally since then, like I just showed in the S&P 500. So, on average over time, when we hit the point that we just hit, 94% of the time, a year later, the market is up, and on average, it's up higher 17% of the time. And even over a 6-month period, 84% of the time it's positive. And just in those 6 months, it's up 9.55% on average. And we looked in this study even a little bit further. When the 200-week moving average is going up, and it is going up right now, this has been right 100% of the time historically. So again, I would never look at just one thing, but the way we do things is we look at a bunch of different factors, and we use that as kind of a weight of evidence approach and to increase our probabilities of either when we should go defensive, when we should go a little bit opportunistic. And right now, from a stock market standpoint, looking at a number of different factors, even though it doesn't feel that way, historically, this would be a good time to add to markets, stock markets in particular, and the S&P 500. So something to consider, something we're looking at as we go into seasonally a very strong time period, but obviously we're feeling pretty concerned about the market right now. At least that's the sentiment of the population. All right, so kind of looking at this chart, breaking down the S&P 500 into kind of two components, kind of the value side of the S&P 500 and the growth side of the S&P 500. This is an interesting year, and it's the mere opposite of what happened last year. So last year, growth was down about 30%. Growth is represented by the gray line. We're only looking at 2022 here, but excuse me, at 2023. So this is year to date. But if you were to look at this last year, they'd all be going down, but the gray line would be going down the most. So that would be large cap growth, your technology, your more growth companies. Those took the hardest hit last year. They're up the most this year. We had a small amount in this because it took a really big hit in 2022, and we saw that it was very expensive. However, in March of this year and various times since then, we've added to the growth side of our portfolio. The value side of the portfolio has been the weakest side of this year. And then you can see in the middle here is the S&P 500, which would be kind of it all together. So I point this out just to say, depending on what side of the market you've been in, if you're a value investor this year, you're down 7%. If you stuck to value stocks, you're down a significant amount this year. If you're a growth investor and you're investing in technology stocks, and that's kind of your area of focus, while you had a wild ride last year and you're down 30%, you're up 34% this year. We like to take a balanced approach and have a little bit of each on both sides and rebalance that over time. And from a valuation perspective, value stocks, if you compare the valuations to their future growth, which is what's called a PEG ratio, they look a little bit more attractive right now. But from a momentum standpoint, the growth side is carrying a little bit more of the momentum piece. So we can make the argument for both right now. One, from a valuation side of things, value looks pretty solid. And from a momentum side of things, growth has definitely got the momentum right now, especially with kind of this AI boom that's occurring. All right. So we often get questions, and we've gotten a lot more of them recently, in concerns, people calling up how they think the dollar is crashing. And so, a lot of people call us up. I'm sure there's all types of, especially if you listen to talk radio and watch any commercials or listen to any commercials on the radio, all types of advertisements for gold and why the dollar is going to crash. And I wanted to point out this chart because this is a long-term chart of the US dollar. And at least to this point, and so this would be kind of around the 2008 timeframe, from that point on, the dollar has been in a very strong uptrend. So nothing at this point is indicating any weakness in the dollar. In fact, it's been very strong. It was exceptionally strong in 2022. It pulled back a little bit at the beginning of this year. It's back in an upward trend in the short term, and it's definitely maintaining this longward uptrend. So we don't see, at least from the reality of what the direction of the dollar and where it's going right now, we see that that's very strong, and that has not been crashing like a lot of people believe. In fact, I even heard a country song that's like this YouTube sensation that's talking about the dollar crashing. But so a lot of people think that that's happening. It's not happening. The dollar is very strong right now, and that's actually caused a little bit of concerns from the standpoint of I'll talk about that in 1 second. But when the dollar goes up, other areas can get weak, like international stocks, which I'll touch on in 1 second. But now that I pointed out that the dollar has been very strong and it's been in a very solid upward trend, I wanted to use this chart here just to show that everything is not perfect with the dollar, and there are some red flags, and we are aware of that, and we do want to consider it. So this chart is looking at the U.S. debt compared to its GDP. It's called a debt to GDP ratio, and this is a way to not just look at the dollar amount of our debt, because you see the dollar amount of our debt, we have $33 trillion in debt. That seems super high, and obviously it is. But it's hard to compare that to a long time ago because of inflation over time and because the economy has grown significantly. So this is a way to kind of compare where we're at now in terms of debt to where we've been historically by dividing it by our gross domestic product, or basically the kind of a way to measure the gross output of the economy. So you can see after World War II, this is the late 40s, was our highest debt to GDP before most recently. So we got up to almost 120% of debt to GDP. And then after World War II, you had a really strong industrial production time frame, and we were actually able to cut deficits, and our debt came down significantly over time compared to the GDP. At the same time, the GDP really went up very fast, which was a big driver, but that was going in the right direction. And then you've had kind of in the 80s all the way up until recently is kind of, this is the pandemic where a lot of money was printed, where a lot of debt happened. The financial crisis, you had a big rally or a big amount of debt that was released to stimulate the economy. So we're actually at new all-time highs in the U.S. in terms of debt to GDP. So that is a concern. However, I would also point out that if you think about where you're going to put your money, or where countries around the world, like who's going to be the reserve currency of the world right now? Is it going to be the euro? Is it going to be the Japanese yen? Or do you have more faith in the Chinese yuan? So if you think about it from that perspective, and by the way, Japan has about a 250% debt to GDP. The Eurozone in general is pretty close to where the US is. So we're kind of the lesser of the evils if you want to look at it from that standpoint in terms of debt to GDP. So we're still, I think, at a point where I'm not super concerned about the dollar right now. However, if we can't at some point start to reduce our deficits, which this is a chart, right? This next chart is looking at deficits. So sometimes people get this confused. Debt is how much money you owe. Okay. A deficit is how much money you are. So let's just use a personal example. So if I have income of 100,000, but I'm spending 150,000, I have a $50,000 deficit. I'm spending more than I'm bringing in. So a deficit is when you're spending more than you're bringing in. The U.S. government and tax revenue is bringing in less than what it is spending, or said another way, it's spending way more than what it is bringing in. So this line would look at the deficit compared to the GDP, which also makes it as a percentage of the GDP, which also kind of gives it a fair measurement over time. And as you can see here, this line right here represents our overall deficit. And it has definitely been trending to a point where we continue to spend more than we're bringing in tax revenue, which means we're going to continue to have to go further in debt. Whatever deficit you had for 1 year, that basically gets added to debt this year, because deficit has to be funded by borrowing money, and you borrow money by issuing U.S. government bonds. So but the other point here is, now that we have higher interest rates, this light shaded pink area, this is how much we're paying in interest on our debt. See, we haven't had an issue with that up until recently because the interest rate of debt has been very low. So you can see this light shaded pink area wasn't really that big of a deal in 2008. because you had interest rates near 0%. But now that interest rates are close to 5%, government bonds are close to 5%. When you issue new bonds, you're having to pay a lot more interest. So this period right here and forward is projected. So this is where we are right now, this dashed line. And as you can see, it looks like we're going to continue to have higher deficits. But the biggest driver of these deficits is the interest that we're spending, the government's having to spend on bonds. So that could be a problem. And again, you have to reduce deficits. You either have to spend less or generate more in tax revenue. Those are the only two ways you can kind of reduce that deficit. And there hasn't been a big move in that area from a government perspective. So that's something that, while the dollar has been very strong, we just want to be aware of this. And while it may not have an effect in the short term, we definitely want to keep an eye on this as we continue going forward, especially if our deficits continue to increase and our debt continues to explode. So, another thing that is important for people to know, like they say, okay, yeah, Jason, there's all this debt, there's these huge deficits. Why is the dollar strong? Why is the dollar going up? Well, the dollar is very much correlated to interest rates. So if you think about the bigger money around the world, where do you want to store your big billions of dollars? You want to store it in a stable currency. That's check mark number one, but you want the highest interest rate. So stable currency, highest interest rate. Right now, that's the dollar. And so as interest rates go up, as you can see here, this year, interest rates have been going up. The dollar goes up in that same time frame. When interest rates come down, the dollar comes down. So this is a highly correlated kind of comparison, and this is the driver of the strength of the dollar. If interest rates are going up, the dollar is going to go up in general over time, and the same thing, if interest rates come down, the dollar comes down. So that's what drives currencies around, the strength of currencies around the world. All right, so I was starting to touch on this earlier, but because the dollar is strengthening, they can hurt other areas. It can hurt international stocks and international bonds, and as you can see, really since the kind of July timeframe, the dollar has strengthened a lot. It's up 3% in the year, and you had international stocks that were up 13 or 14% in the year. Now they're only up 5%. This is negatively correlated. So as the dollar gets stronger, international stocks tend to go down, and so the dollar being strong hurts international stocks, because you're having to invest in the dollar, and their currencies are getting weaker compared to our dollar. So that's how it affects international stocks. It also is negatively correlated to gold. So as the dollar strengthens, you can see in general during this time, gold has gone down. Gold's the gray line, the dollar's the blue line. However, you can see this spike in gold recently. That is, so gold's up 6% in the year. It has been coming down as the dollar's been strengthening, but this point right here marks the attack on Israel and the whole conflict between Hamas and Israel. Big geopolitical concerns. A lot of times when that happens, there's a flight to safety, and gold is considered a safe asset. So you do tend to have more money going into gold. So that you do have a big spike in that recently. And so we do, gold is something that we do own in our current portfolios, and it is something that we are considering potentially adding to. Even though the dollar has been strong, and typically that's bad for gold, that has caused a pullback and potentially an opportunity to add to our gold position. So we're looking at nearly a 20-year chart of gold here, and you can see it has been uptrending. That majority of that time, you had a really big pullback after 2011 through 2016, but we've kind of continued in this long-term upward trend since then. However, you have this like really long-term resistance up here where the dash line represents where we are right now. The solid line kind of represents this long-term resistance. If you can start to break above that, there could be a significant long-term rally in the dollar. And from a longer-term basis, if some of the deficits, some of the debt do eventually start to have a negative effect on the dollar, or if you go into a recession and the Federal Reserve has to cut interest rates. Remember, if interest rates go down, that weakens the dollar. And gold tends to go up when the dollar tends to go down, then gold should benefit from that. So gold does tend to be a good asset to own in a recession or in a slowdown, and especially when the dollar is getting weaker and there's inflation. So it is something that we should have as a portion of our portfolio, to protect in that type of scenario. And we think this recent pullback over this last, kind of 6 months to a year is given an opportunity to maybe add to our position. So that's one thing that we're looking at right now, is adding to our gold position. So another negative effect that dollar strength has is it brings down not only international stocks, but also emerging market stocks. And I showed this chart for two reasons. One, you can see, when the dollar really started rallying, kind of from that July timeframe, meaning when interest rates went up here, you can see this is a bunch of different emerging market countries and stock markets, where the emerging market index as a whole is this green line. But you can see as the dollar went up, these went down. However, the other reason I want to point out this chart is that all emerging markets aren't equal. Right now, there's definitely a negative consensus about China and investing in China. It's becoming more difficult, and there's a lot more conflict between the U.S. and China these days. So China is the dark blue line, and this year it's down 6%, even though emerging markets are up 1%. But there's been some benefits, or been some kind of positive countries where you see India up 7%, and you see Mexico actually up 13%. And so especially the Mexican side of things, I wanted to touch on that because it's something we're looking at. After the whole pandemic shutdown happened, and you had this huge supply chain issue where a lot of China shut down, a lot of manufacturing is being done in China. What that did was it caused a lot of countries and a lot of companies to reevaluate their manufacturing and not being so much at the mercy of the Chinese and Chinese manufacturing. So there's been a big movement to reshore, meaning bringing manufacturing jobs back to America or back to your own country, or what's called friendshore, bring it back to closer countries. And so a closer country would definitely be like a Mexico. And so this has, positive ramifications, this kind of reshoring, going away from China, bringing jobs back to the U.S. or bringing jobs back to closer, more friendly countries like Mexico and some of South America, Canada. But so that's been good for those countries, and that's something that we're watching on to look to see if we should overweight that side of our emerging markets. At the same time, it's been an issue with inflation. So China has cheap manufacturing. So does Vietnam and Asia and around that area. Mexico has cheaper manufacturing than in the U.S., but it's more expensive than China. And definitely the U.S. labor is way more expensive than China. So as you have this big move to pull back jobs to the U.S. and pull back jobs to friendlier countries, you're increasing your manufacturing costs. That makes inflation a little bit more sticky, because now that you're having to pay more for labor, not only in the U.S. and in Mexico compared to China and some of the other cheaper labor markets, you're having to pay more in labor now. So that causes those products and services to be more expensive. So speaking of which, this is a chart of inflation. So that was one driver of inflation, kind of this reshoring. Obviously, inflation spiked a lot, and as we went into 2022, kind of peaked out midpoint of 2022. The dark blue line is the CPI. The light shaded blue line is the core CPI. There's a lot of different ways to measure inflation. The point that we're making here is kind of the general trend. They've definitely been trending down. The core is really the more important one to watch, even though they're both important to look at. But you can see the core has been trending down. The light shaded blue line area, both of them have been trending down. But you need to get kind of towards this 2% area. That's where the Fed wants you to get to in order for them to start, stop raising interest rates and potentially even start cutting interest rates. And it looks obviously like we're trending towards that direction, but we haven't got there, and we still have a ways to go before we get there, with the core CPI right around 4%. And this recent spike in inflation is gas prices starting to go up more recently. So you have two things. Let me flip back here. So I'll touch on the gas price in a second, because that's affected by the geopolitical. But the CPI, covers food and energy, whereas the core CPI removes those more volatile assets. So the more volatile assets have been declining slowly, whereas some of the food and energy recently, especially energy, has jumped up and caused the CPI to go up. But one of the biggest sticky areas of inflation is the labor market. And so you can see this dark blue line here is job openings, and the light blue is the total unemployed. So you can see, obviously you had a huge spike in unemployment when the pandemic happened and job openings went down a lot, but then that reversed significantly. And now you had a crazy amount of job openings and very few unemployed. At one point, it was 2 to 1. So 2 job openings for every 1 person looking for a job. Now it's about 1.5 to 1. So you get 9.6 million job openings, 6.4 million unemployed, meaning potential people looking for jobs. You can see that this has started to turn a corner, started to go up. So you're having a little bit more unemployed. Not that I'm cheering for unemployment, but that would help the inflation standpoint. And you have seen that job openings are turning down, but we still got a pretty big gap here. And when you have that gap, it causes employers, one, to pay more to their employees to keep them in their company. And two, employees are attracted to go to another company to get paid more. So you're having to pay more for labor. That's good for the employee because they're getting paid more. However, when people get paid more, they spend more. And when you spend more, that's a big driver to inflation. So that's something that, that's been one of the reasons why inflation has stayed high. And so, a component of that too, 2 things here. You have an aging workforce. So a lot of people are retiring. So you have less people looking for jobs. And then you have what I was talking about, the reshoring of manufacturing jobs and bringing back jobs, to America. So causing more job openings. So, you have a lack of workers. And that can only be really solved by either job openings and the economy getting worse, or immigration and immigrating more people, or people having more babies. And we're not having as many babies as we used to have. So, but the point here is that this is a sticky side of inflation. It means that this is why it's difficult to get inflation coming down, because you still have to pay a lot more for labor. And another sticky area is housing. So this is the owner's equivalent rent. It's a measurement of kind of if you were to take your house and rent it out, the growth rate year over year right now would be 7.1. So you'd be able to rent it out for 7.1% than you would higher than a year earlier. That's still a very high amount. As you can see, the long-term average is closer to 3. But we have peaked here. I pointed this out last quarter, and it was just turning a corner. It is starting to trend down. So that is encouraging. That one of the biggest component of the CPI is housing. And so people are having to pay more, whether it's through a mortgage or whether it's through their rent, mortgage with higher interest rates, rent from what I'm showing here. So if people are having to spend more there, that's an inflation driver. So that's another thing. So this is oil. So oil, while it's not a sticky side, it is something to point out because some of these geopolitical concerns have caused oil to spike recently. And, year to date, oil has gone up, especially since July of this year. You can see oil driving higher. So if oil continues to stay higher, that can also be a driver of inflation. This is a lot more volatile, and it can go up and down. So we don't like to only look at oil, but if it does tend to stay higher, the impact there is you pay more for your flights, you pay more for your food because it takes more money to ship the food. The tractors that produce the food or mine things, you're having to pay higher fuel costs. So oil does, act as inflation, especially if it stays higher. It flows through to goods and services. All right, so that takes us to kind of what the Fed is doing, the Federal Reserve doing, and kind of what that has to do with the economy and especially bonds. So this has been the difficult thing this year, is because interest rates keep going up higher than what everyone is expecting them to go up. And these dashed areas are expectations. So when the blue line here is the federal funds rate. So you can see the federal funds rate went from essentially 0 in late 2021. Now it's all the way up to 5.25 to 5.5. And so one of the biggest spikes in interest rates in the last 100 years. And then if you look at the projections going forward, the good news is all 3 of these projections show that we've topped and there'll be no more interest rate hikes. However, that is something that we pointed out in April of this year, that it looked like the Federal Reserve had peaked. Now, at that time, you had a banking crisis that looked like it was going to continue to be serious. And a lot of times the Federal Reserve will raise interest rates until something breaks. And it looked as if something broke with the banking crisis. They stepped in, resolved the crisis for now, and it's kind of gone away. The economy has improved, confidence in the banking system has improved, and then everything I've shown with the job market has continued to stay strong. So that has caused the Fed to have to raise interest rates even further. And then last quarter, it looked as if interest rates were going to peak and come down at a faster rate. This is the most recent reading right now, October 16th. So the dash blue line still shows that federal interest rates have peaked, and they are going to come down as we go into 2024. So, interest rates and bond prices are inversely related. And so obviously one of the worst bond periods of all time when interest rates are going up at this rate. When interest rates start to come down, that's an incredible time to invest in bonds. When interest rates are going down, bonds tend to go up. It's hard to, no one knows the future. It's hard to time exactly when that's going to happen. But there is a high probability that we have peaked in interest rates and we're going to eventually start to come down. So this chart just shows kind of the negative correlation, the exact negative correlation of yields going up. So yields have gone up a lot since the bottom of 2020, since January of 2022 when interest rates started going up. You can see, a little less than 2 years ago, the 10-year Treasury had a yield of 1.5%, and now it has close to 5% in terms of what a 10-year Treasury yields. So when interest rates go up that high, the price, which is the blue line here of the aggregate bond, which kind of measures the overall bond market, the price of bonds go down. So if you wonder why bonds have done so bad, they've done so bad because interest rates have gone up so high. But these are negatively correlated. So when interest rates come down, bond prices go up. As you can see, this little spike kind of towards the end of 2022 and going into 2023, when yields started to come down, bond prices went up. And so at some point, you're going to have interest rates peak again. And I think we're getting closer to that point. And at that point, bonds will do really well. But we've gone through a very difficult time frame in bonds. As you can see here, just this year, you do have a couple parts of the bond market. High yield bonds are actually up 4.7%. High yield bonds, corporate bonds, tend to be very correlated to the stock market. So since the stock market has done pretty good, high yield bonds have done good. The difficult part about that is if we go into a really bad economy and the stock market starts coming down, then corporate bonds should come down and there's a higher default risk. So we don't want to put too much money, and we don't have too much money in this area because at some point these high interest rates are going to be a big weight on high yield, what's also called junk bonds. Money markets have been solid, so they're paying closer to 5% right now, but they're up this year 4%. You can see how just kind of the general bond market is down 2.6. Longer term bonds, which are the most interest rate sensitive, this year are down 14.4%. So that's taken a big hit. We held very little long-term Treasury bonds during 2022 when it took almost a 35% hit, but we started adding to them at the end of 2022, and they initially went up a lot. They've come down recently, and this is something that we're looking at, adding to as interest rates eventually peak. This is going to be the area that goes up the most when bonds start to, when yields start to come down again. So that is something that we think is a really good opportunity, but it's very difficult to call the exact bottom in bonds. So you never want to just kind of go all in that one area. You add a little bit to it. So right now, what we've done is we've taken what's called a barbell approach, where we hold a good portion of our bond portfolio in money markets, which are stable, and then we have another portion that owns these long-term treasuries. And so that way you have one stable area that is not fluctuating with interest rates, but is getting over a 5% yield right now. But you have this other area that you're looking to that we're steadily getting into as we think eventually bonds will bottom and come back up. Okay. And then obviously we do hold some core bonds, which would be this kind of U.S. aggregate bond. And actually we do hold a little bit of emerging markets as well, which is held up. So, but this is a really important thing to kind of look at over time. This is kind of taken what's called quantitative analysis and looking at the last 100 years of bond markets. And unfortunately, you don't have statistics on the aggregate bond because that index hasn't been around 100 years, but you do have history of like a 10-year treasury bond, which is a good measurement of bonds. And what this looks at is it's the worst 2 or 3 year declines in the last 100 years. And I point this out because, well, a couple reasons. In the last 100 years, we've never had 3 years of negative returns. And as of right now, there is a chance this year will be negative, and the bond market is down 2.5%. Not a big negative, but it's still down this year. So there is a chance you'll have 3 negative years in a row in bonds. That's never happened in the last 100 years. So part of this is to say, usually when bonds take a big hit, they have a big rally that follows. The other piece is just to show you the magnitude of the drop that we've recently experienced. So 1955 through 1956, bonds over that 2 year period was down 3.59. The next 1 year, it was up 6.8. The other really bad time was 58 and 59, down 4.75. And then the next year, during that time, the next year, bonds were up 11.64. The late 60s, very similar from a job market standpoint. That was the last time we've had a labor market as tight as we have right now. So there's a lot of similarities to now in kind of that 1969 timeframe. But during that time, 3 year period, even though those 3 years consecutive weren't negative, for that 3 year period, you were down 3.3% in bonds. The very next year, it was up 16.75. And the last one here, which was at the peak of the inflation in the late 70s, bonds were down 3.1% in that 3 year period. There was one positive year in between there, but cumulatively down 3.1, whereas the very next year was 8.2. So during those worst 4 time periods, right after the worst 4 time periods, you had an average return of bonds of 10.85%. Look at the drop that we're currently in. So, from 2021 and 2022 and all the way up until year to date this year, the 10-year treasury bonds are down almost 30%. So I tell you that to say people don't understand the magnitude of the drop in the bond market. And it's literally the worst of all time in US history. And what has made it so difficult is that bonds and stocks have dropped at the same time. So you had to get really creative if you're trying to managing risk. A lot of times you'll have your bonds go up when your stocks go down, and vice versa. They're both going down, and they're actually both going up at the same time. They become much more highly correlated, which it hasn't been the case for the last 20 years. A lot of people will look at this number and say, that is horrible, like down 27%. Why would you invest in bonds? Well, if you look at whether the stock market or the bond market, your best returns almost always come after your worst returns. So I say that to people because we get the question all the time, why aren't we just all in a money market? It's earning 5%. And I say that because there's a very good chance at some point, and we believe in the near future, that you are going to see a rebound in bonds, and it will be a significant rebound, way more than 5%. And even though cash right now or money markets are yielding 5%, the 10-year average on money markets are closer to 1%. And even the projected returns in some studies of money markets over the next 10 years is closer to 3%. So by the time your money market rate starts coming down and bond starts coming up, if we go all money markets right now and the bond market reverses and starts going higher, by the time people feel comfortable to get back in, remember the sentiment chart, when people sell when they're the most scared. So if we waited till we felt better, we would miss out on a huge market, a huge return in bonds when interest rates started coming down. So that's why you can't go all cash, even though we do think cash is a very strategic component that you should have as part of your portfolio in this type of environment. And we do. It's one of the biggest components of our bond side of our portfolio. You got to be very careful going all cash after the drop that we've just had. It would be almost like, I use the analogy of trying to go cash in March of 2009 after the bottom of the stock market. People didn't feel like investing in the stock market at the time because it would take such a big hit, but it had a huge rally after that. So if you sold at the bottom, you missed out on a big return. So this chart on the right just kind of shows you visually what I've been explaining. All right. So just kind of quick summary, and we're going to get into, Paul here. Both stocks and bonds have pulled back. There is improving valuations. Inflation is trending in the right direction. Odds do favor the Fed funds rate peaking and dropping next year. So, there's definitely a case you can make if you have extra cash above and beyond your emergency reserves, because a lot of people have had a lot of extra reserves and they've gone a lot more into cash. Now would be a time to start. And I'm not saying you put all your extra cash into the market, but now could be a time to start adding some of that extra cash. You have bonds down significantly, stocks have pulled back. Seasonably, we're in a very we just finished one of the weakest time periods, starting into a very strong period. Interest rates look like they're peaking and starting to potentially come down as we go into 2024. So now would be a decent time to start considering putting some of that cash and redeploying it back into the market, obviously according to your risk profile. All right, so that sums it up. So Paul, you want to take it from here?
Absolutely. Thank you, Jason. And before I continue with the slides, a few slides that I'm going to share, I want to remind everyone you're free to ask questions about the presentation, your thoughts, concerns about market, etc., in the Q&A box. So please feel free to just go ahead. You can't raise your hand or anything of that nature in the presentation, but you can type up any questions that we'll try to get to here in a few minutes once I'm done sharing a few happenings at AllGen. So please ask away, and we'll get to you in a second. But did want to share a few things that are not market related necessarily, but do have to do with what we provide and bring to our clients. Just some more resources for you above and beyond these quarterly webinars. We have our dynamic portfolio investment review videos that one of our team members or a few of our team members, Christina, Ryan, or Jason, they make those videos and we send them out to you periodically. So please be looking out for those in your email, in your inbox. And we have our monthly investment management blog that also Ryan or Christina or Jason put out on a monthly basis, obviously. So just to keep you informed, I know, again, as Jason mentioned, it's a interesting time. And in the beginning of the webinar, we got a lot of sentiment that says, oh, we're really concerned. So especially when these things happen, when sentiment is, there's a lot of nervousness out there. We like to make sure we're letting you know, hey, we're watching this stuff, we're making adjustments accordingly, and really looking to minimize that risk so we can position you for a better return in the future, but also in alignment with your plan. So speaking of that, we do have a few other tools that we want to share with you. We had mentioned this previously in our previous webinar, but we have launched 2 new platforms here at AllGen for our clients. The first one, and not in any order, is on the one on the left here, you see is Right Capital. It's our new financial planning portal. For those of you that have financial plans, we used to use another platform, which is still a good platform, but technology changes, and we want to make sure we stay abreast of all the technological advancements to bring efficiencies and effectiveness to you guys. So if you've updated your financial plan recently, you've been privy to the new platform, which is your portal. It's an app that you can see on your phone. It shows all these different metrics, very interactive in terms of communication with the advisor. We can put tasks of things to do, notes for the meetings, forecasts. We can do a little bit more tax planning with our clients. So we're very excited about that. So if you've had the privilege of updating your plan, again, you've seen it. If you haven't updated your plan, we're going to encourage you to do so whenever it's the time to do that. So that you can actually have access to the new platform and see the benefits of that in your financial planning process. Also, we introduced this Advise on it's the new investment management platform or portal. Here you can see we used to use Morningstar before, and now we've changed platforms to Advise. I think it's a fresher look. It's a little bit more updated technology, if you will. So we've gotten a lot of great feedback so far from persons that we launched this literally last week to our clients. So we've gotten great feedback. A lot of people have already signed in, been able to see the portfolio. Unfortunately, they're signing in a time when things were down. But at the same time, you can put that in context with what Jason's been mentioning here, that it might be a good time to deploy assets, and you can see what our team is doing literally on a daily basis. So feel free to log into these portals for your benefit. And if you have any issues or concerns logging in, please reach out to us and let us know what's going on. So lastly, our financial planning updates. We're last quarter, right? So we're nearing the end of the year here. A few deadlines to keep in mind. If you're a business owner, it's sometimes a 401k or solo 401k is a great tool to have for one, investing for your future, but also getting tax deductions depending if you do Roth or not. But if you're going to establish a plan, they have to be established, not funded necessarily, but established, paperwork in, and say, okay, it's open by December 31st. So if this is something that might make sense for you because your taxes are too high, you try to figure out how to minimize taxes or save for retirement or both, please reach out to us and we can help see if that makes sense for you and get that going. Also, it's open enrollment season for a lot of our company benefits, for those of you who work for an organization, for health insurance and other benefits. So this is something that when we're doing planning, sometimes we say, oh, you might need more life insurance or you may need disability or things, an HSA, to be able to maximize an HSA qualified insurance plan to be able to put money into an HSA. This is a time where often you can make those changes in your benefits. So be looking out for that. And if you have any questions on that, please call us. Your financial advisor is happy to help make the right selections for you according to your financial plan. Roth conversion. This is the time we start looking at, does that make sense or not, given your tax bracket, given your asset allocation, your income streams for this year versus next year forecast. So those have to be done by the end of the year. And then RMDs, which is your required minimum distributions and qualified charitable distributions, QCDs, also have to be done by the end of the year in order to, one, make sure you don't penalize on the RMD side, or that you qualify for that potential tax reduction that the QCD allows for. So those are a few deadlines that are coming up in the next few weeks, or by the end of the year. I want to remind you of those. So now we're going to get to a couple of questions. Again, if you have any questions that come up in the next few minutes, please feel free to type those in, and we'll get to them as soon as we can. But I'm going to ask a few questions that have already come through. So Jason, I've got a question here, which gets a little technical, but that's your world. So it says, Jason, what is your thought on Buffett's indicator ratio on July 31st, which is a couple of months behind, and we know a lot's happened since then. But on July 31st was 182% for the U.S. stock market being overvalued. This is arguing for, and this person put, as I understand it, a roughly 18 to 45% drop in the market to move the stocks more in line with valuations.
Wow, good question. So the Buffett ratio basically takes the market cap of the whole U.S. and divides it by the GDP. And it's kind of a simple way, well, simple and from a nerdy mathematical financial person point of view, but to kind of come up with the valuation of the market. And if the market has become such a bigger portion compared to what the GDP is, it's a ratio to kind of see if we're overvalued or not. I actually do track that indicator. Not that obviously we track thousands of indicators, we don't rely just on that one, but that one has actually been overvalued for about 5 years, significantly overvalued for 5 years. I think it got above 200 at one point. I think there's a couple of reasons for it being overvalued. Obviously, if you just went off of that indicator, you would have missed out a lot of the rally in 2021 because it went even higher. And the market rallied significantly after it was already kind of signaling an overvalued market. But I also think there could be a chance that will steadily get higher over time as you kind of have more globalization and more free markets, so that more of the there's more companies publicly traded or more money, especially when you look at like 401ks, and as money floods into stocks over time, that does just naturally become a bigger portion of the overall GDP. So, I think that will naturally kind of go up a little bit over time. However, Warren Buffett's a pretty smart guy. And, I wouldn't disagree that stocks are overvalued a little bit from that metric. Actually, they're overvalued significantly from that metric compared to historical means. But I just think that's going to have a natural tilt of an upward trend, because I think the stock market will naturally become a bigger part of the GDP with the way that people use 401ks, and that's the majority of where money goes, where that wasn't as relevant, 50 years ago.
So recap, yeah, you see the metric, you understand it, we actually consider it, but not necessarily the only metric we'll consider in thinking, oh, the market's going to tank, because it's overvalued right now.
Yeah, and using the kind of the weight of evidence analogy, you have to kind of weigh a bunch of things that would say the market is bearish, or the market could potentially go down, or weigh a whole bunch of things that the market, is undervalued and could potentially go up. We would put that one on the side that the market could come down. and you kind of weigh out that balance to see how many indicators are pointing to a certain direction. So that would be one that you would put on the side, but that wouldn't be the only metric that you would look at, but that would indicate the market is overvalued.
Very good. Okay, another question. With the global baby boomer retirement mainly occurring now, global baby boomer retirement mainly occurring now, um, global baby boomers will move their money from stocks to more secure investments and thus make capital costs higher for stocks and investment capital almost everywhere throughout the world. What are your thoughts on that?
Wow, another great question. There's a lot of ramifications about the baby boomer, especially in the U.S. Market. One is that you have less workers. It's not answering his question, but that's one. So that does force the kind of the labor market to be a little tighter, which could cause inflation to go higher. I mentioned that earlier on. But when you have so the tendency over time, and his point, and it's an accurate point, the tendency over time as you get older and as you retire, you go from maybe this accumulation phase where you're more aggressive and maybe moderately aggressive and higher percentage of stocks in your portfolio, but then now as you kind of move into retirement, you go more into bonds, to be a little bit more safe. So a couple things there. If the first point I made, if it does drive inflation a little bit higher, when you have higher inflation and higher interest rates, that causes valuations of stocks to be pressed lower. So that could be affect the stock side of things. It would, in his theory, if more money goes to bonds or safer assets, that if that was a follow through, and I'm not going to say that's completely happening, but if that was to happen, you would have more demand for bonds, and if you had more demand for bonds, that would lower interest rates, which would then help the valuation of stocks. So it could have its pluses or minuses. We do study the whole baby boomer phenomenon, if you will, and what the ramifications are for that. Obviously, it increases healthcare costs significantly. So you got to look at healthcare stocks. And healthcare stocks, could have a little bit more demand as you have, more people spending a lot more money on healthcare being in an older age. So that's something we consider. So yeah, we definitely look at those demographics. I'm not sure if it, purely is a negative for stocks though. And I think especially after bonds have had such a big hit, even though we believe it's a great opportunity there, maybe people have been scarred from from bonds, and they think that stocks have held up better, in which they have at certain periods of time. So maybe that causes people to buy more stock. So there's a lot of ways you can go with that thought process, but interesting to kind of to go through and follow the logical sequence there.
Very good. Another question we had is the lower USA credit rating impacting the deficit?
It could over time. I don't think it has yet, but it definitely could over time. You had the other time where you went from a AAA credit rating to a AA. I think it was either 2011 or 2013, but it was the last time that kind of you had this budget impasse where they couldn't agree on a budget or raising the debt ceiling. It was all kind of connected. And because you couldn't raise the debt ceiling, we got close to a default. That scared a lot of the world, including the rating agencies, and they lowered from AAA to AA. After that happened, it didn't drive the thinking is if you have a lower credit rating, then you have to pay a higher interest rate. But that wasn't the case at that point in time. So one downgrade, I think people have seen it happen to America and they don't think it's that big of a deal. But if you continue to have a scenario where you cannot agree on a budget and you cannot agree on raising the debt ceiling, and you can't agree to have a responsible budget that doesn't kind of get out of hand and have these huge deficits, and there is a lot of concern out there if we will be able to make those important decisions and we will be able to come to an agreement, since you have two very polarized sides, then I think that is could be a negative long term and could cause potentially, in that scenario, that could cause credit agencies to consider if they should downgrade it again. And at that point, yes, it starts to have a negative effect. I don't I don't lean that. That's not our base case scenario of that happening, but it is a possibility over time, especially as you get further in the future, and something that we keep an eye on just in case.
Very good. Well, with that said, we want to thank you for joining us today on our quarterly webinar as we head into the end of the year of 2023. We want to wish you all the best, great health, much joy and love during the holiday season coming up. And as always, please feel free to reach out to us, whether it's to ask any more questions about markets, investments, your portfolio, or your financial plan, which is usually the foundation of where we think everyone should make decisions. So thank you again, and we look forward to hearing from you soon. Take care. Bye-bye now.
Take care.